Namaste and welcome back to Smart Credit with Sangeeta, your trusted guide for understanding the secrets to a successful MSME loan approval in India. This is part 4 of our CMA report series for bankers and credit learners. I will mention my previous videos link in the caption. You can go back and watch there. So today we will understand the current ratio, one of the most basic yet critical liquidity ratio in MSME credit appraisals. So grab your chai, pen and paper and let's discuss how current ratio is a crucial metric every credit officer, banker or business owner in India should know. Whether you are evaluating a loan request or assessing your own business health, understand the current ratio helps you to make informed, confident decisions. Let's start. Imagine this, you are a banker and a business owner walks in asking for a 50 lakh working capital limit. They show you the sales number, a few invoices and say, trust me, my business is doing well. But as a banker, trust is not enough. You need proof of liquidity. That's where the current ratio steps in. Your quick check to see if the business can meet its short-term obligation without choking its cash flow. Today we will break down the current ratio in a way that's impossible to forget. So you can calculate it confidently, interpret it like a pro, and even guide MSMEs on how to improve it. So let's start. So let's start with the formula current ratio equal to current asset divided by current liabilities. To understand current ratio better, we need to understand its component first. Okay. So let's quickly revise the balance sheet. Balance sheet has two components. One is liability and second one is asset. So let's discuss liability first. Liability is what a business owes. Now it is further broken into following components: equity, or you can say capital, non-current liabilities due after 12 months, current liabilities due within 12 months. Okay. Now let's move to asset side. Asset is what the business owns. These are divided into non-current assets. You can say further fixed asset and intangible assets which are due which cannot convert into cash within 12 months, and the next is current asset which can be converted into cash within 12 months. Now let's move to the current ratio formula. Current ratio equal to current asset divided by current liabilities. Let's take some example of current assets first. Okay, current assets can be cash or cash equivalent. Here now cash equivalents are RD and you can take the RD and FD that are maturing within 1 year, and bank balance, your current account balance, inventory, and this inventory includes your raw material, work in progress, and finished goods. Receivables that are also called as debtors, short-term loan and advances which are recoverable within 12 months. Your prepaid expenses such as insurance premium, advance to contractor or advance rent. So next is current liabilities. Okay, now the example of current liabilities are sundry creditors, or you can say them accounts payable, outstanding expenses or short-term borrowings, and bank overdraft. Many people take bank overdraft as non-current liability, but this is a current liability. When you check your sanction letter, you can see there are condition that it is due. Bank can close it, or bank can ask to pay you back as an on demand. Okay. Next is current portion of term loans due within 12 months. This is very much important since term loan is considered as non-current liability, but the EMI you are going to pay within next 1 year, that will be taken into current liabilities, right? Now you understand what are current asset and current liability. So now let's go to benchmark. In MSME, what is the benchmark? RBI and most banks expect a minimum of 1.33 ratio 1. This is the benchmark ratio for for maximum MSMEs. Now, current ratio describes companies' ability to pay its short-term obligations. Now, this means, suppose, for every rupees 1 of liability due within a year, the business should have rupees 1.33 worth of current assets. This you can understand with these two jars example. One jar is full of this is marbles. This you can say current assets, and one jar is full of marbles. This is your current liabilities. Current asset jar has 133 marbles and current liability jar has 100 marbles, right? Now you understand from this whether you are in safe position or not. Since the ratio is 1.33, the business is in the safe position. Now, why do bank even care? In MSME credit appraisal, the current ratio tells the bank, is the business liquid enough to meet day-to-day expenses and short-term debt, right? Is the working cycle healthy? Is there risk of cash crunch leading to defaults? Here's a catch. A ratio that's too low signals liquidity or stress, and or you can say cash crunch, or even in the worst case it can be diversion of funds. And you know what is the ratio that indicates? Less than 1. And when the current ratio is less than 1.33, this indicates your liquidity stress. So but when a ratio is in the range of 1.33 to 2, this is a healthy ratio, and this gives a green signal to say yes, right? But when a ratio is too high, you can say more than 2.5, it means inefficient asset uses, or maybe too much idle inventory or uncollected receivables. Business is not making optimum utilization of its resources. So when the ratio is too low, that is also dangerous, and when the ratio is too high, that is also a dangerous position for us. Now let's take an example. Current asset of a company is cash and bank balance is suppose 2.5, inventory of 8 lakhs, sundry debtors of 5.50, and short term investment of 1 lakh. Now total current asset total is 17 lakh. Now similarly we look for current liabilities. Sundry creditors 4 lakh, bank ODOCC is 3.5, other current liabilities 1.5, provisions are 1 lakh. Now total, when you do the total, it's 10 lakh. Now let's calculate the current ratio. Divide 17, that is current asset, by current liabilities. Now the current ratio is 1.7. Now you understand this way, the company has 1.0 rupees of current asset for every rupees 1 of current liabilities. Now you notice the safe position. However, notice that inventory forms nearly 47% of current assets. This is a crucial affecting factor for our interpretation. You need to look whether this asset is lying for more than 12 months. Okay, so now let's move to Indian context challenges. In India, especially with MSMEs, two major problems skew the current ratio. First is overstated receivables. Many MSMEs I have seen throughout my career, many MSMEs show old invoices as collectible, but in reality payments are delayed beyond 6 to 9 months, and many times it's more than 12 months. Now, overstocking inventory. This is a very dangerous challenge. Business pile up goods before demand in certain locking cash in stock. There are many MSMEs or many businesses you can check. They just keep the stock and keep on adding so that it can show their current ratio in better position. Current asset increases and this increases their current ratio. But in actual, the asset that is lying, that is the stock, that is too old, and maybe that is not possible to sell. So as a banker, you must always verify aging of receivables, inventory turnover period, and creditors payment terms, right? Now you understand why bank ask for age-wise data quarterly and half yearly for calculation of DP, right? Now how MSMEs can improve current ratio? Here's a practical tip from my side for business owner. Speed up your receivable collections. You can offer early discounts for this, reduce your unnecessary inventory. If your inventory is stale, you know that this item is not sellable in market, replace it. Negotiate long credit terms with the suppliers. Avoid short term borrowings for long term asset purchase. Now we have seen many companies or many MSMEs, they avail working capital limit to purchase factory land and building. Although they can go directly, they can tell their banker that we need this amount for purchase of land and machinery, but they want to serve that margin as from working capital. So always avoid it. Always maintain cash reserves for seasonal dips. Now, for bankers, suggest working capital term loans to convert short term debt into manageable repayments, right? Monitor quarterly statement to ensure ratio stays healthy. This is very much essential. Always monitor that. So, what are the red flags? As a credit officer, these warning signs should immediately trigger deeper investigation. First, a declining trend. Sorry. A drop from 2.1 to 1.4, then to 0.9 over 3 years often indicates over trading, poor collection management, or increasing supplier pressure. And sometimes this also indicates diversion of funds. So always check for it. If you see the declining trend, ask for them, check it thoroughly. Excess inventory, a current ratio of 3 looks great, right? Until you realize 80% comes from slow moving inventory, indicating poor demand forecasting, right? Now, inflated receivables, when debtors constitute over 60% of current asset and debtor exceed 90 days, even a healthy looking ratio becomes meaningless. Now, most of you are aware that maximum banks lend for debtor period for 90 days. In some cases, this is 120 days, but maximum cases 90 days. So, always check for it. Now, what are the common mistakes we as a banker make? We include long term advances in current assets. I've seen this many times. Now, ignoring current portion of term loans in liabilities, not adjusting for dishonored checks and receivables, we never check for this, and blindly accepting balance sheet figures without stock audit reports. That is why banks have policies of unit visit, stock verification, stock audits periodically. The people sitting above us only want to safeguard public's money by reducing the risk. They don't want to risk the money, right? Now, next time, whenever you are doing balance sheet analysis, just check it thoroughly. Go for unit visit, check their stock register, and you will know the clear picture. Okay. So now let's get back to our opening scenario where a businessman approached the banker for working capital limit of 50 lakhs, right? You remember in the starting, right? Now let's discuss. The company profile is 15 years in business, consistent, profitable, but the current ratio is 0.8 and quick ratio is 0.6. Industry average is 1.4. Now, based on data, bankers finding are 70% of the current assets are inventory. Average collection period is 120 days, although the industry collection period is 60 days. Now, major customer contribute to 40% of sales. Seasonal peak is observed from October to February. Now, what do you think? What can be the risk factors? Let's discuss them. High customer concentration, right? Since 40% of the sales are from a major customer. Slow receivable collection, as the industry benchmark is 60, but the company's is 120 days. Excess inventory levels, 70% of current assets are inventory. Below industry liquidity, right? So, what do you think? The whole scenario is in front of you. What do you think? Should the banker decision be? Should banker approve it or reject it? Most of you might be thinking, why should we consider even the current ratio is low and the industry is running slow? Reject, right? But let me tell you one thing, rejection is not the solution every time. There is a word in banking, risk mitigation. We can mitigate the risk. So now what mitigation steps should the bank take? Since the customer is asking 50 lakh initially, can it be possible 30 lakhs limit? We can give them 30 lakh and based on performance we can increase the limits later on. We can ask monthly stock statement and this can be mandatory in your sanction letter. Quarterly review meetings, that is your visit reports quarterly. You can schedule, you can check for stock register, and you can ask the customer to improve collection period, right? Always remember, conditional approval with enhanced monitoring. Sometimes a lower ratio with proper mitigation is better than outright rejection. If you will not sanction, there are many banks they will sanction. So just look for conditional approval also. You can help any business through this also, right? So key takeaways. As we conclude today's deep analysis of current ratio, let's summarize the key takeaways. Okay. Now for bankers, what you can do as a banker, current ratio is a starting point, not the destination, right? I told you we can mitigate the risk. There's always an option to mitigate the risk, right? Industry context and trends matter more than absolute numbers. You need to always check, right? Quality of asset is as important as quantity. Seasonal and cyclical patterns must be considered. Understandable. Now what are the key takeaways for the business owners? Maintain your ratios appropriate for your industry. Focus on your asset quality, not just quantity. Regularly monitor your accounts. This prevents crisis situation. Build relationship with bankers before you need them. I always say that. So current ratio formula is current asset divided by current liabilities. But most importantly, remember that behind every number is a story. Your job is to understand the story completely. So if this video has helped you understand current ratio better, please like and subscribe for more banking and financial insights. Share it with your colleagues, knowledgeable, anyone who needs this knowledge. Knowledge shared is knowledge multiplied. Until next time, keep analyzing, keep learning, and keep growing. Thank you for watching. This is Sangeeta signing off. Thank you.